This is Daybreak Asia. We're counting down to Asia's major market opens. And Haidi, I think it's that focus on where central banks go next. We had that preferred inflation gauge for the Fed coming in, pretty much meeting estimates. So that helps us think, OK, perhaps 3 Fed cuts over the course of this year. The BOJ, though, a little bit mixed messages, perhaps, because you had Ueda saying one thing, one of his ministers or members of that BOJ committee saying something completely different.
Yeah, how much was Governor Ueda kind of trying to temper those expectations that had been set up, spiked up right from the previous signalling? Look, he says the price target is not yet in sight, but there is that sense, you know, to borrow the words of Mary Daly from the San Francisco Fed, the readiness is really coming into sight for a number of these central banks. But of course, let's take a look at how markets are kind of deciphering this at the open.
Yeah, and you've got as well what's playing into it from the Japan perspective is the tight labour market, because we had those jobs numbers out just in the past half hour. The unemployment rate falling to 2.4%, revised 2.5% a month earlier. So something that does put some upward pressure on wages and wages. We know we want to see sustained salary gains in order for the BOJ to be able to shift its policy settings. But as you said, yes, that a way to call perhaps tempering some of the expectations of the market, because he's just been in Brazil after a meeting with a group of 20 or G20 finance chief, and saying they're not in a position as yet to see their sustained stable inflation target, countering, as we said, what came through from a board member yesterday saying that actually the price target was finally coming into sight. So just some of the different headlines we're tracking about the BOJ, really. But as we said, Ueda saying that BOJ inflation target not yet in sight. Markets-wise, you've got the Japanese yen continuing to hold at that 150 mark. Stocks a little bit more positive. But as I also said about that preferred inflation gauge for the Fed, meeting estimates pretty much, still hotter than the 2% target for the US. But it does certainly allay any concerns about really resurgent inflation. And so if you change on now to what else we're expecting, Australia 1 hour into the session, but we did see US stocks hitting record highs. Breaking news as well, actually, to note, we just had South Korea releasing its trade data. And what we're seeing here is exports beating or passing what economists had been expecting here, a rise of 4.8% on the year. That is well past what the survey had been for 1.4%. Really does sort of play into that global demand that we're seeing for chips. It is steady, but it is supporting those economic recoveries in South Korea, its Asian peers. So the imports numbers there, you can see better than expected on the year. Exports, imports, we are seeing a contraction territory, down more than 13%, so worse than what economists had been forecasting. And also the trade balance here, quite a big difference, $4.3 billion there, Heidi.
Yeah, Belle, take a look at Australian stocks. Really a highlight in terms of the standout market that we're watching so far this Friday session. We've seen the Australian share market soaring to a record high. This is a market that is set for a bull market now, come off, 20% from those 2022 lows. It's a positive lead, certainly from Wall Street over that. But if you take a look at some of the market leaders at the moment, materials off the session highs, but still leading the pack up by just about 1%. We're also seeing tech stocks do quite well as well. Materials being sort of supported by the fact that we have seen after a few weeks of weakness, iron ore coming off that 4-month low in terms of iron ore prices, and that's really giving some support to some of the heavyweight miners here in Sydney. We're taking a look at the Aussie dollar at 65.02. It was a kind of give and take picture when it comes to the dollar index overnight, reacting a little bit more negatively to that inflation print, and we are seeing really Treasury futures that had extended their climb. We're seeing Aussie bonds rising in reaction as well. Yields had retreated from near their highest levels of the year after we had that preferred measure of inflation, preferred by the Fed, I should say, matching estimates for January. So those rate cut expectations to begin in June have really been kind of remaining intact, if you will. Oil very quickly headed for that weekly advance, spread signalling some market strength, and we're seeing near-term time spreads widening further in bullish backwardation as well. And we are, of course, waiting for OPEC Plus members to make their production decision early in the month as well. That energy markets have kind of been, seeing steady rises as a second monthly increase in February, but again, very tight ranges when it comes to crude trading. Let's bring our next guest who wants to fade some of the crowded positions that we see in markets at the moment, including locking in gains in Japan. With us now is Mark Franklin, who's a senior portfolio manager at Manulife Investment Management. Mark, great to have you with us. And of course, the darling trade, the Nikkei 225, what sort of, tactical long positions would you perhaps be pulling back from? And where do you see further opportunities that are still untapped for this market?
Good morning, Heidi. So we've been tactically positive on Japan for a while now, and it's obviously had a very, very strong run, particularly led by Nikkei and the more growth-oriented parts of the market. The conversations that we saw in the market yesterday, particularly from Takata, who is a member of the policy board, highlights that we are approaching a judgment point for the Bank of Japan. We've got the spring wage negotiations coming up. If they prove to be positive, then the Bank of Japan may conclude that will be a sufficient underpinning for consumer price inflation to get to and remain at their 2% target. That may then encourage a modest marginal shift in their monetary policy, particularly around negative interest rates, but potentially also yield curve control. And so then what that might catalyse is a rotation within Japanese equity markets, perhaps towards the banks. But at the very least, what it might do is reverse the profound weakness that we've seen in the yen against the major crosses, including the US dollar in the last year or so. And that creates somewhat of a short-term headwind for Japanese equities. So that's why we've been selectively and modestly taking some profit and locking in gains year to date, because we are approaching a point of judgment for the Bank of Japan.
And of course, adjacent to Japan, particularly when it comes to the same sort of themes and policy narratives that we're hearing, South Korea has staged quite a turnaround. Are you optimistic about the number of announcements that we've seen, the sort of value up program, of which we have scant details, but there's been a lot of investor optimism. Is that also a good option?
Well, like Japan, Korea has somewhat suffered from a corporate governance overhang for many, many years now. It's a low valuation multiple equity market. Now, some of that is due to the fact that it has a cyclical sector mix, but it is also due to corporate governance and shareholder return policies or lack thereof. So I think that the government in South Korea is genuinely serious about basically creating a watershed moment, and you will see more and more of the large companies reassess their shareholder return policies, whether that's dividend policy, cross shareholdings, inefficient use of capital. So we do think this theme could effectively spill over from Japan into South Korea, but it's going to take a number of quarters, potentially years, for this to become a widespread thematic rather than isolated to a few corporate examples.
Mark, we had that preferred inflation gauge for the Fed coming in overnight above that 2% target, but still not panicking investors, because it does seem like inflation could be coming down. Fed rate cuts, we've got 3 that are priced in, 1 fully by July. Do you think that is the right approach?
Well, if we come back to the beginning of the year, the market was pricing between 6 and 7 rate cuts, and the Fed's dot plot in the January meeting was for 3. So the market took the view that the Fed was incorrect and that there would be more room to cut rates. Now, fast forward today, 3 of those rate cuts have been priced out. The market's pricing is much more aligned with the Fed dot plot. What that probably suggests is that we're due for a period, albeit a narrow window, of relatively stable bond trading, yields being fairly range bound, and that creates an opportunity for investors to get exposure to more carry elements of the fixed income markets, whether that's the US Treasury market or other high-yielding markets such as New Zealand and Australia as well. So we think for the time being, rate pricing will be fairly stable. But as we start to head towards the middle of this year, May and June meetings for the Fed, they will be forced into reassessing whether current pricing and the timing of those cuts remains appropriate, and we'll also have more data around inflation and growth. One of the things that we're wary of at Manulife is the fact that the US is running a very large fiscal deficit with no sign of a more modest fiscal approach. Financial conditions are broadly easy. Does that catalyse a renewed surge, renewed pickup in inflation in the second half of this year? That may challenge rate cut pricing in the market, not just for 2024, but also 2025.
And we've seen that impact of higher rates really playing out on some of the more regional lenders in the US, but smaller banks as well. And one overnight that had big headlines was NYCB taking that huge hit to its earnings, around $2.4 billion, and the stock slumping off that. But I'm curious what you're seeing in terms of that sort of regional banking risks, whether you see that spilling over into Asia at all, or whether that's resurgent again from what we had last year. And as well, those lenders that have high commercial real estate exposure, is that something that you're tracking?
Yes, one of the things that is apparent is that those banks, both regional in the US and overseas, that have significant exposure to the office commercial real estate market in some of the US metropolises are being forced into valuation reappraisals, and that's hit NYCB pretty hard. We've also seen a bank in Japan, Bank Aizora, also take write-downs, and there's also a bank in Germany which has had a lot of exposure to the office sector. We also need to look at some of the other real estate sectors as well, because there is still an occupancy issue and a rental payment issue in not just office, but also commercial and some of the housing commercial real estate subsegments. What we would say, though, is because of the percentage of loan book concentration in commercial real estate being that much higher in the US regional banks, we think it's more of a challenge for the regional banks rather than the banking system as a whole. So we don't see it as something that's systemically a risk just yet, but we think it creates an opportunity to express sectoral preferences both on the long and the short side, for example, within the US small and mid-cap space.
Mark, that was Mark Franklin there, Senior Portfolio Manager at Manulife Investment Management. And still ahead, we'll speak exclusively with the CEO of Singapore's main taxi and public transport operator as their international expansion plans gain traction or momentum. ComfortDelGro CEO SK Cheng joins us shortly. This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show, premieres around the world Monday at 9 a.m. Hong Kong time on Bloomberg. Context changes everything.
China's top leaders have pledged to meet economic targets as the 24-member Politburo met ahead of next week's National People's Congress. Our Chief North Asia correspondent Stephen Engel looks at the many challenges faced by lawmakers gathering in Beijing.
The National People's Congress, or NPC, is China's annual session of parliament, convened usually every spring in the Great Hall of the People next to Tiananmen Square in central Beijing. Essentially, the NPC sets the political agenda for the year ahead, when the nearly 3,000 delegates from around the country get their marching orders on day one in the form of a lengthy work report from Premier Li Qiang. While regarded as the highest organ of state power, the NPC nevertheless operates under the direction of the Communist Party of China. The NPC, by design, legislates and executes the directives of the party. The roughly two-week affair is colloquially known as Lianghui, meaning the two sessions, as the NPC is preceded by a gathering of the Chinese People's Political Consultative Conference, or CPPCC, an advisory body supposedly representing views from the broader society and business community. Even though party membership is not required to be in the CPPCC, it is nevertheless directly supervised by the Communist Party.
Bloomberg's Chief North Asia correspondent Stephen Engel there. Well, talks of the World Trade Organization conference in Abu Dhabi have been extended to a fifth day. Member nations are struggling to reach agreements on a range of key issues. Bloomberg's Paul Allen joins us with more. So clearly quite divisive and a lot of complex issues. What are the main sticking points?
There are a few sticking points. So one of them is around this area known as stockholding, which has nothing to do with stocks. It's about countries buying grains from farmers at predetermined prices. And, well, that looks like a subsidy by any other name. India, which is a huge player in these talks, says this is really about food security for 800 million extremely poor people. Then you have trade purists, for example, Australia, Brazil, saying, well, look, this is distorting the trade environment and it's preventing these countries from exporting for what would otherwise be a really huge market. Similar sorts of issues around fisheries. India pointing to the need to protect subsistence fishes. Indonesia calls this, a matter of daily life and death when it comes to feeding people, and it's just these small fisheries that aren't really part of the problem. And then you have issues that appear separate to it but sort of connected, like around e-commerce. At the moment there are tariffs prohibited on e-commerce. Those are due to expire, and you'd think, well, those things aren't connected, but in talks they can be used as a bargaining chip to get movement on the rest. So yeah, it's a very, very complex and intertwined issue.
And given those complexities and interrelatedness, the chance that this conference ends without an agreement or a stalemate, what is the chance of a stalemate, really?
Well, there's always a very real chance that there is no statement and it wouldn't be a first, or there's a chance that we'll get a really watered down statement and some sort of addendum that says, well, look, these are the areas that we really couldn't resolve. But as dark as it looks, you've got to remember also that there's more than 160 countries involved in these talks. So far, 17 paragraphs of text have been agreed, so plenty of encouraging signs. The Director General also says, look, some things are proceeding in a good way, other things proceeding in not such a good way. But Ireland's Trade Minister put it very well also, saying, look, there is a lot of pessimism around this, but sometimes you get this before you get these big breakthrough agreements. And the sign that this is even pushed into a fifth day, we're likely to get some sort of resolution one way or the other by 2 o'clock this afternoon in Abu Dhabi. There is clearly a will for all member nations to just keep on pushing and see what can be achieved.
Bloomberg's Paul Allen there with the latest on the WTO meeting. Well, President Biden says he remains hopeful about a ceasefire in Gaza, but that it's now unlikely to begin by Monday, as he had previously stated. He's also warning that a deadly confrontation around an aid convoy in Gaza will complicate negotiations. Bloomberg's Mike Heath joins us here with more. And Michael, so these two are clearly, connected stories that we're looking at here, because he had previously been hopeful, but by early next week that a ceasefire would be able to take effect.
Yeah, I mean, look, that looked relatively optimistic when he said that, just because of some of the mood music on other fronts there. But he did speak with Egypt, with the Egyptian and Qatari leaders again yesterday, and obviously there is a real push by those guys to get going. The problem is, as you mentioned, that there was this. Scores of Palestinians were killed or injured in this fighting, or this not fighting, but violence that occurred in northern Gaza, where some aid trucks came in from Israel. They were swarmed by people who were obviously desperate for food and sustenance, and there's conflicting reports on what occurred. Some say that there was aggressive moves towards Israeli soldiers. They fired in response. Others say that the trucks were trying to escape, that people were on top of them and that sort of thing, and people were crushed. So it's unclear, but nonetheless, a lot of people dead or hurt there. And again, that just makes it more difficult to sort of square the circle. Hamas is already saying perhaps this just takes a ceasefire off the agenda. But we'll have to wait and see. The idea, though, is that there'd be 6 weeks of a pause or a stop in fighting. Hamas would release Israeli hostages, Israel would release Palestinian prisoners, and a lot more aid could get into these people. So there's a lot at stake here if they can get it done. But yeah, I mean, it's hard to see, whether this can be achieved or not.
And you just say that difficulty of squaring things up, it also comes out in other forums as well. We were just discussing the WTO perhaps not ending with a resolution, but also G20 was very, very split over Gaza and Ukraine as well.
Yeah, that's right, Annabelle. They couldn't come up with a statement on those issues in the end, and it will come out as sort of a chairman's statement from Brazil after that. And Brazil, rightfully to some extent, said that the finance ministers isn't really the forum for discussing these sort of geopolitical issues, though they do have a lot of obvious economic fallout there. But they've just referred obliquely to Ukraine and to the Middle East conflict. The Ukraine one's a bit more difficult to tell. I mean, there's a US-led group that has condemned Russia, has imposed quite stringent sanctions on it, and others who, while they've opposed the invasion or condemned it, haven't done anything with sanctions. And there are others who are sort of, perhaps China quite sympathetic towards Russia. On Israel, basically outside of the US, most want a ceasefire now, so there's a bit more agreement there. But the US is obviously very powerful. But yes, they couldn't come to an agreement on that, so that ball sort of kicked down the road there.
Bloomberg's Michael Heath with the latest, and you can get a roundup of the stories you need to know to get your day going in today's edition of Daybreak. Bloomberg subscribers go to Daybreak on their terminals. It's also available on the mobile in the Bloomberg Anywhere app. You can customize those settings as well, so you just get the news on the industries and assets that matter to you. This is Bloomberg.
Taking a look at how crypto prices are faring in the session today, it's pretty flat. We haven't really budged off that level for the past 24 hours or so. We're still sticking around that point. It has been a big run-up, though, over the course of this week, and we are at a 2-year high, so perhaps just a little bit of wait and see for what's next. But certainly there are calls for Bitcoin to head even higher. It's this demand for Bitcoin ETFs. It's as well the demand for Bitcoins off the back that Bitcoin miners can't meet that with the supply at this point in time. But we have spoken with Galaxy Digital's founder and CEO, Mike Novogratz, and he says even at these sorts of levels, crypto is looking very frothy. That's after, as I said, Bitcoin surged to its highest price in more than 2 years. Novogratz told us he wouldn't be surprised to see some sort of correction, but still he expects the original crypto token to end the year much higher.
This is probably the first time in the history of Bitcoin that we have true price discovery. And what I mean by that is this is the first time that anyone who wants to buy it has easy access to buy it. And so, right, baby boomers have $85 trillion of wealth. Their wealth is, for the most part, managed through registered investment advisors who now, at least half of them or some portion of them, can just buy the ETF. And so you're seeing, a step function in new owners of Bitcoin, which is driving, I would say, a frenzy in the whole crypto ecosystem, right? So how crypto always works is Bitcoin gets bought and some people sell a little bit to buy Ethereum and they try to play the catch-ups and the altcoins. And I would say we've gotten to very frothy levels. You can see it in the funding rates of the altcoin market, how much you get paid to actually lend out your coins in Bitcoin, Ethereum, and all the alts. And so you saw it in the equities, the public equity markets, right? MicroStrategy, Marathon, all the kind of public equity bellwethers really went parabolic along with Bitcoin. And so I wouldn't be surprised to see some correction and some consolidation. But I'm very loath to pick a Bitcoin high because I really do believe this is price discovery. Will we test the old high? Most likely. And you'll probably have some consolidation. But I still think we're going to end the year much higher.
It's interesting to hear you kind of come in with some caution in the middle of this euphoria. It begs the question, what's also the new low?
We broke out from 45,000, and so that would probably be what should hold us if there's a real correction. You never know why corrections come. Something happens and people shift mindset, and there's a lot of people that have bought recently. I don't think it'll get there, quite frankly. I think if it corrects, it probably corrects to the mid-50s before taking off to the new high. First the old high, that's 68, 69,000, where we got pretty close. But I do think then you're going to see, and partly this is, if you look at Fidelity or any of these big platforms that have so much baby boomer wealth, just shifting 2 to 3%, 1 to 3% of those assets, encouraging their customers to shift to Bitcoin over time, which has been an amazing diversifier, is a monster number.
That was Galaxy Digital founder and CEO Mike Novogratz speaking to Bloomberg's Shonali Barsak. We have more to come here on Daybreak Asia. This is Bloomberg.
We want to avoid holding on all the way to 2%, putting policy very tight, and then cause an unnecessary downturn. We are agile, and we're sitting in what I call the ready position. We are ready to make moves and adjust as the data demand us to do. And I think right now the economy and policy are in a good place to do that.
I'm of a view that it'll probably be appropriate if things go the way I expect to see us to start to reduce rates in the summertime.
Was the San Francisco Fed President Mary Daly and Atlanta's Raphael Bostic speaking as the Fed's preferred inflation metric increased by the most in a year. And take a look at what we're watching here in the Asian session this Friday. As we've said, quite a bit of buoyancy when it comes to the Nikkei 225. Japan stocks extending those gains by about 0.8% there. We're seeing the topics putting on about 0.5%. The story really has been, when it comes to the rally here in Australia, though, finally kind of rising to that record high that we've been waiting around for quite some time. A big support comes from mining stocks in particular, lithium and gold miners really dominating that crowd, but a little bit of an uptick when it comes to the iron ore miners as well, as prices start to see some uplift as well. Consumer staples also doing quite well, but healthcare on the other end of the spectrum dragging the other side that we're watching here. But the SX 200 looking pretty flat at the moment, but still up 20% from that 2022 low. So we are set for that bull market close in this session. Kiwi stocks are on the back foot of about 0.3% earlier. Of course, earlier, I should say, we did speak to the RBNZ Governor, Adrian, and he spoke about the need for patience and just the decision-making that went into the ultimate decision to hold in this week's meeting. He is now also speaking before the Chamber of Commerce in Canterbury, saying inflation is still too high but declining, that expectations have declined when it comes to inflation, but that policy needs to stay restrictive for some time. He has said that 5.5% for that OCR is where policy needs to stay, at least for this calendar year. He does expect to begin normalising policy by next year. Belle.
Yeah, and Heidi, just recapping some of the PMI data that just dropped, PMI readings, private surveys, but pretty good update on the health of economies around the Asian region here. So you are just seeing those pretty stable, really, you'd have to say, across the board. Not too big a moves, really, in either direction. Broadly, you'd say it's a little bit of weakness has come into some markets. Indonesia, for instance, you can see you've also got Thailand, for instance, that's a slight deterioration there. Taiwan as well, a slight deterioration. But still other ones picking up. It's not too much of a change here, but certainly we do track these PMIs closely because you want to see that sort of South-North Asia divide between the ones that can be more of the commodity exporters and you've got more of the tech ones in the Northern Asian region. All very sensitive, though, to what's happening in China's economy. But that's the picture you've got there. Asia PMIs just released here, Heidi.
Yeah, Belle, and that Jibun Bank Japan reading for manufacturing is actually the lowest since August 2020. So it's an interesting kind of macro picture that sets up for the Bank of Japan, particularly as we had really the continued tightness in the labour market, looking like it'll keep upward pressure on wages. We heard from Governor Ueda just today saying that wage growth is really what they're scrutinising amid what has been really some mixed signals perhaps from the OJ policymakers about when they might pull the trigger on policy normalisation. Governor Ueda says the price target is not yet in sight, tempering the speculation that the first rate hike since 2007 might be just around the corner. Let's get more from our Asia Economy and Governance Senior Editor, Brian Fowler. So, Brian, sort of on the balance of things in terms of the data, because we know that central bankers just want to get back to looking at the data. What are the scenarios that could play out, and what's the likelihood that we're looking at here?
Yeah, well, we've seen some kind of conflicting signals from people over the last couple of days. And, I mean, just Takata, just to go back for a second, Takata sent the most clear signal yet that it's time to end the negative interest rate. He said that the BOJ's price target has come into view. He said that it would make sense now, it would be fine to downshift the monetary policy gear. So that's definitely a go signal. Then Ueda, as you mentioned, Ueda came in just a couple hours ago. He's in Sao Paulo at the G20 meeting. And he said kind of mixed things. He said, on the one hand, the wage situation is looking pretty good. The companies are coming through with some fairly robust pledges for wage hikes. But he also said, in contrast to what Takata said, he said the price view is not yet in sight. However, on that point, going back to the data, let me just point out that next Tuesday, we are going to get Tokyo CPI stats for February. These are key stats, the leading indicator for national trends. In January, that inflation rate came in at about 1.6%. Well, we expect, because of base effects, because of utility subsidies that kicked in a year ago, we expect that the inflation rate is going to surge in February, and the consensus now says it'll be about 2.5%. So it's conceivable that when those figures land on Tuesday, that could be one really key component, one piece of evidence that Ueda could look at. And it's just possible he might say that, yes, in fact, the goal has come into sight at that point. We'll see. But that's a strong data signal.
But would it mean really the target is secure? Because I think over the course of this week, we've had quite a lot of different Japanese eco points out, and they've been pretty mixed, really. We had factory output, for instance. There was that plunge on the month, perhaps that auto production halt playing into it. But certainly a tight labour market, as you said. We've got this inflation one to look forward to. What's sort of the sense? Japan in technical recession, there's a lot really going on and to try and decipher.
That's definitely, yeah. So the recession was something we all thought, oh my goodness, that was a surprise. No one really thought that that GDP was going to shrink for a second quarter at the end of last year. However, since that time, Ueda has come out a couple of times, and he said basically that nothing has really changed in terms of his assessment of the economy, that he still believes the gradual economic recovery will continue and gain some momentum. So basically what he's saying is, that some of that bad stuff we've seen is not going to change the game plan for the BOJ, at least in terms of the negative interest rate. Now, it could affect what happens after the end of negative interest rates. So if you thought that maybe they were going to hike once again before the end of the year, maybe they won't do that. So, but it's pretty clear that even after they end the negative interest rate, policy settings will remain accommodative, and whether there's another a couple basis points hike or not remains to be seen.
Brian Fowler, our Asia Economy and Government Senior Editor there. Well, we are also due to get China's February PMI data in the next hour, and Bloomberg Economics looking like activity will have pulled back due to, of course, that disruption from the 8-day Lunar New Year holiday. The data release comes as China's top leadership pledges to meet economic targets for the year while maintaining social stability. The 24-member Politburo will submit a government work report next week to the National People's Congress. Global investors will be looking for more forceful stimulus measures from Chinese authorities as the MPC gets underway. Let's get more from Bloomberg's chief rates correspondent for Asia and MLive contributor Garfield Reynolds. And Garf, it's kind of a catch-22 because obviously they use the growth target to send a signal of strength and confidence. If they set it too high and don't back it up with a significant amount of stimulus, they might miss it. So I do wonder what the right answer is there.
Yeah, well, it's difficult to know what the right answer is as far as the target goes. Does depend very much on what do they do to back it up. And in fact, in general, there's a growing sense that they need to do some big bazooka stimulus or at least a moderately sized bazooka stimulus.
But a bazooka.
Yeah, but a bazooka. And that's not something that the Xi regime has shown a lot of appetite for. However, they've done things to stop the stock market from falling. They have talked about helping the property sector. The central bank has definitely made some easing moves, and they're getting to the stage where it's looking like monetary stimulus has done about as much as it can. So then they need fiscal stimulus if you are going to significantly turn the economy around. You also need to find some way to fix the property sector, which isn't really what you would expect to come out of the National Congress anyway. So that fiscal stimulus is kind of needed, and that would matter much, much more if they could set a disappointing GDP target, but say they're going to stimulate, and that would matter much, much more than setting a more optimistic target and not providing that bazooka I was talking about.
Yeah, well, we can keep with the theme of bazooka here. I mean, what hasn't really ended up being a bazooka is any sort of monetary stimulus that's come through from the PBOC, because there's a lot of concerns over the effectiveness of it. And when you've got those funding costs that are falling across Chinese markets, are we setting up for some sort of liquidity trap here off the back?
Yeah, I mean, there have been some people even who said that they're facing a balance sheet recession. There's a lot of skepticism about that, but that does, highlight the concern. What's a liquidity trap? Well, that's when by lowering interest rates across the economy, you actually spur people to save more money, because the flip side of low interest rates for borrowers is low interest rates for lenders, i.e. for depositors, for savers. And Chinese consumers are already facing a potential reason to save more because the real estate sector is melting down. That has been where a lot of people have looked to put their money, is to invest in real estate. So you're saying, well, I don't want to invest in real estate. Prices are coming down, so I don't necessarily want to make big picture purchases. And also interest rates are coming down, so I need to put more of my own capital aside rather than look to spend, because I'm not sure what I'm going to be able to fund my retirement with, how I'm going to cope going forward. So that's the liquidity trap that's looming. Those low interest rates, the 30-year bond yield has dropped by the most in a long time. That's unusual. All that says we don't need anything much from the PBOC. What we're looking for is for the government to come to the party.
Bloomberg's chief rates correspondent for Asia and MLive contributor Garfield Reynolds there. And starting next week, we'll be introducing a brand new program focused on Asia's biggest economy. Bloomberg's The China Show is your definitive source for news and analysis. Our very own Yvonne Mann and David Ingles will bring you all the market moves, plus in-depth discussions with all the key players. The China Show premieres at 9 a.m. Monday in Hong Kong. That's 8 p.m. Sunday night if you're watching in New York. More to come here on Daybreak Asia. This is Bloomberg.
Next week, Bloomberg brings you the latest from China's annual National People's Congress, including China's budget plans, economic outlook, and geopolitical tensions. Coverage begins next week on Bloomberg. Context changes everything.
You're watching Daybreak Asia. Well, Singapore's main taxi and public transport operator, ComfortDelGro, has reported a 4% increase in full-year net income following a year of international expansion. Let's cross over to Singapore. Our Bloomberg Markets Asia co-anchor Haslinda Aman is standing by with the company CEO. Haz.
Well, that's right. We're talking about SK Cheng, Group CEO of ComfortDelGro. He's been in that position for just over a year. SK, good to have you with us. First time with us here in the studio. I'm just wondering, looking at how the global environment is right now, you're in 12 countries. How are you assessing the business environment? Can you outdo the 4% increase in revenue that you've seen so far?
I think thank you for having me this morning. But looking at the environment that we're in right now, the 4% increase that we've seen this year is actually a big improvement for us because we actually had a one-off in 2022 because of a sale of property. So actually, if you look at, you minus the exceptional items, we are at 26% increase at the PATMI level, and that's very encouraging for us. But more importantly, what we're seeing is that the different segments that we are actually in, we are seeing a quarter-to-quarter improvement, and that to us is a very encouraging sign of how the business is growing. And if you look at the various segments that are in, from the point-to-point, public transport, and also the adjacent business, we also made good headway last year. And now we are also growing the rail pillar that we have, bidding for rail contracts and winning rail contracts in both Paris and Stockholm last year. So those are very encouraging for us.
And you have been expanding internationally. You talk about Paris. You also expanded in Europe. You bought a land transport company there. Are there plans to raise more funds so that you can more aggressively expand?
Well, we are in a fairly fortunate position right now because, as you see, land transport business is a cash-generating business. So our balance sheet is very strong. We have enough credit lines and all that. So we don't need to raise funds at this point in time. But clearly, we're very focused on executing our strategy to grow the business. We look at point-to-point transport. We look at public transport. We also look at adjacencies. So these are where we look at opportunities that we will actually continue to look at, and we will grow where it's appropriate. For example, in Australia, we make a bid to actually acquire the largest taxi company in Australia, and that is actually in the process of actually being acquired subject to shareholders' approval in Australia.
When is that deal likely to be sealed?
They are going to go to a vote in end of March, and probably will seal hopefully in April.
Singapore still accounts for the bulk of your business. 60-40 is what we're seeing right now. Is there any plan to counter that? Perhaps, get more of your revenue from overseas versus domestic market?
Well, you're right. I mean, Singapore is a smaller market compared to the rest of the world. But in absolute proportion, we are not looking at whether it should be 60-40 or whatever that it might be. But we are focused on the strategy. Again, looking at where the best value is, getting the best value for the shareholders, having a very deliberate, disciplined approach to acquiring business and growing the business.
Well, the thing is, you're facing increasing competition right here because of the deals that might go through. We have a Grab thinking of merging with Transcap, Grab, GoTo as well. How might that play out for you, and how are you countering that potential competition?
We have been very focused in terms of growing and strengthening our taxi business in Singapore. And likewise, we are also looking for good business, point-to-point business, whether it's the UK, whether it's Australia. So as far as we are concerned, we see that as something that we will continue to focus in terms of delivering the best value for our consumers. We see a position where the taxi will always play a role in the various markets that we're in. We know that taxi will provide better reliability. Taxi also provide better value for the consumers in the long run. We want to make sure that we can deliver on that. So when we deliver on that, it means that we have to look at how do we actually enhance the customer experience. So in the past, we look at the typical taxi app that you have. Right now, if you look at the taxi app, the quality of taxi app, the delivery of taxi app.
But Aske, these are mega deals. Might you have to come back with your own acquisition in Singapore?
So if you look at Singapore, we look at the taxi industry. So the question is that how do we go forward? So we focus again on what do we do to make sure that we have an ecosystem that best brings value to the consumers.
So no acquisition plans? In terms of the Chinese market, we know that the economy there has been pretty lackluster. What are you experiencing in terms of business there? Is it back to pre-COVID levels?
I would say that in the past year, it has been improving. It's certainly not at the pre-COVID level, but we have seen strong returns and strong recovery quarter on quarter in the Chinese market. So across the whole of China, actually we have 9,000 taxis at this point in time. 65% are fully electric.
Currently, the Singapore market is undergoing a review. The ride industry is undergoing a review. What do you hope to see? What might come out of it?
Well, we certainly want to see the ecosystem such that you have a vibrant taxi, you have a vibrant P2P market, because the two markets actually plays different parts to fulfill the entire transportation point-to-point sector. So what we really want to see is that making sure that the field is level and both parties have a right to actually compete on a more equal footing, and that allow us to actually grow and strengthen the taxi market to serve the community better.
Aske, before we let you go, a lot of angst in the city about how difficult it is to get a cab, despite the fact that you've raised prices. Why is that, and how are you countering that challenge that we're facing in getting a cab?
We need to get more taxi drivers to come to the rank, and we are always looking for opportunities to grow that. Change the scheme of employment, encouraging more people to come in, attracting different people who might not have considered driving a taxi. We want them to join us.
And it's challenging?
It's just always challenging. Well, the manpower constraint is challenging to everybody.
SK, thank you so much for that. ComfortDelGro Group CEO, SK Cheng. Haidi, the angst here in the Lion City, you just can't imagine.
As in there in Singapore. More to come here on Daybreak Asia. This is Bloomberg.
JD.com is cutting the price for its cloud services. That move follows Alibaba's decision to discount as the AI boom helps trigger a growing price war in the hotly contested cloud business. Let's get more from Bloomberg's tech reporter Jane Zhang joining us. And yeah, as we were just discussing there, this follows Alibaba's move yesterday. Alibaba is the market leader in this space, but just talk us through the sort of size and scope of this price cut.
You know, on JD.com's post today, posted yesterday, they said, cut all you like, we'll fight to the end. They didn't disclose like specific percentages of the price cut, but I think Alibaba's price cut can give us a reference point. Alibaba said it would cut its price of over 100 products to as much as 55%, and the average is 20%. So JD.com also promised that they will offer the lowest price, and if you buy more expensive, they can compensate you.
It's not just the likes of JD and usual rivals, right? The competition has been really difficult for Alibaba. How do you assess the broader industry and which players we should be talking about?
Yeah, the competition in China's cloud computing industry has really been intensified in the past few years. Alibaba has always been the market leader, but the market share has been shrinking over the past few years. And this is partly or mainly due to the aggressive measures done by China's state-owned players. And I think that's also why this is the second time that Alibaba did a major price cut in a year. Actually, Alibaba Cloud has gone through a lot in the past year. First, the company announced a full spin-off early last year, and then there are management reshuffles. Eddie Wu, the current group CEO, took the helm of the cloud unit as well, and then later they canceled the spin-off of Alibaba Cloud due to the U.S. chip ban. So I think, yeah, there is really a lot going on in Alibaba Cloud.
It's not often you have the opportunity to exponentially grow the pie. Could it be the case through AI that there's just more to go around for everyone?
Yeah, almost all cloud computing players want to ride on the wave of the boom of ChatGPT services. And Alibaba Cloud actually disclosed that half of China's generative AI firms are now running on Alibaba Cloud services. But I think the common challenge here is China's economy is so weak and enterprises are more reluctant to spend on IT infrastructure services. So yeah, I think that's the basic challenge here.
Bloomberg's technology reporter Jane Zhang there. Taking a look at some of the stocks that we're watching when it comes to the ADR shares that were trading ahead of the China Open. We just mentioned, of course, JD.com cutting prices for cloud services, really triggering this price war across cloud computing with these steep cuts with Alibaba. We're watching NetEase falling overnight as game sales missed estimates, and also the US is looking to investigate data risk posed by Chinese EV companies. China PMI data is coming up in the next hour. This is Daybreak Asia.